market opportunities in the fast-paced world of 2026 vanish in mere milliseconds. Seizing an edge requires immediate, frictionless capital deployment. You spot the perfect trade setup, but if your funds are stuck in transit or bled dry by hidden transfer fees before reaching your account, the opportunity is already gone. This chart maps the speed versus friction trade-off defining the current financial landscape. It's the core framework for evaluating your funding. Watch how a single deposit splinters. The rail you choose functions as your first trade. Its speed and cost directly determine your starting equity. Your capital moves along one of three main rails: traditional bank wires, digital crypto networks, or instant e-wallets. Pick the wrong rail for your specific strategy, and you lose profit margins before you even analyze a currency chart. Let's start with the traditional cross-border bank wire. This is the baseline standard built for large-scale position traders.
Its primary advantage is institutional security. When moving $10,000 or more, paying a flat wire fee makes mathematical sense compared to giving up a percentage of your capital to a third party. But relying on legacy cross-border infrastructure forces you to accept clearing delays. A 1 to 3 business day wait completely kills your agility. The modern regulatory environment compounds this. Stricter KYC and AML checks mean banks will frequently request source of funds documentation, pausing your transfer entirely. AML stands for Anti-Money Laundering, a set of regulations requiring institutions to verify the origins of large sums of money. Central bank digital currencies introduce a new variable. CBDCs are digital tokens issued directly by a nation's central bank, perfectly pegged to its fiat currency. They could essentially streamline these wire speeds, but they will also give central banks unprecedented visibility into your individual transactions, eliminating financial privacy. Traditional wires act as a highly effective defensive tool for protecting large amounts of capital. However, their inherent friction makes them entirely incompatible with high-frequency trading. Cryptocurrency offers the exact opposite approach. It is a decentralized peer-to-peer rail that settles across borders rapidly with zero intermediary banks. But using standard unpegged assets like Bitcoin introduces a massive vulnerability: the volatility trap. This line chart tracks a Bitcoin deposit over a 10-minute network confirmation window. If the asset drops 5% before hitting your broker's ledger, you are forced to start your Forex position in a mathematical drawdown. The optimized standard solves this by using stablecoins like USDT or USDC. These digital assets are perfectly pegged to fiat value, eliminating price swings during transit. Watch the chart flatten out. By routing those stablecoins through low-fee networks like Tron, you achieve near-instant speed for roughly a single dollar. Tron utilizes the TRC-20 standard, a technical framework for smart contracts known for extremely low transaction fees. This speed requires absolute personal responsibility. You must secure your own hardware wallets and always send a $10 test transaction to verify the address before routing your full balance. Stablecoins provide the optimal midpoint for speed and cost, provided you accept total liability for your own operational security and network routing. Then there are e-wallets like PayPal or Skrill, engineered specifically to provide a frictionless user experience. For nimble scalpers reacting to sudden breakouts, that one-click, near-instant market access is incredibly effective. Look at this cascading waterfall chart of a $2,000 deposit. Providers immediately slice off a sneaky 2 to 5% deposit fee right at the top. Then a second chunk disappears. If you deposit a fiat currency different from your account's base currency, the provider applies a highly unfavorable conversion spread, shrinking your usable capital even further. Providers are also implementing strict KYC blockades that can unexpectedly freeze your capital. KYC stands for Know Your Customer, a mandatory identity verification process used to prevent financial fraud. Furthermore, do not assume consumer protections apply. Attempting a chargeback on a legitimate trading deposit results in an immediate and permanent account ban from your broker. E-wallets buy immediate speed at a premium cost. They are a tactical tool for high-urgency setups, not a default everyday funding rail. You must stop evaluating payment methods in a vacuum and start evaluating your own trading style. Match your specific scenario to the correct rail. If you are a high-frequency scalper, you require immediate liquidity to catch short-term volatility. Stablecoins or e-wallets are your mandatory choice. If you are a position trader moving large capital, the multi-day wait of a bank wire is mathematically justified by the flat fees and institutional security.
This decision tree maps out exactly where your capital belongs, based on your time sensitivity, deposit frequency, and transaction size. But choosing the right rail is useless if you hit an infrastructure bottleneck. If your broker lacks multi-rail support or charges arbitrary withdrawal fees, they actively force you into suboptimal deposit methods, leaking your margin before trading even begins. Notice how these optimized pathways converge. FXNX is an infrastructure partner built specifically for this landscape, supporting all these funding rails natively. They offer instant crypto deposits equipped with AI-driven fraud protection, alongside highly secure traditional wire routing. They complement this robust deposit infrastructure by maintaining 0.0 pip spreads to actively protect your trading margins. Coordinating your funding rail with FXNX's multi-rail infrastructure ensures your capital reaches the account intact, allowing you to focus on execution rather than administrative friction.